Alrighty, folks, it is that time of year. It is that time of year to hear what the experts are saying. And as a real estate channel, I know I am interested to hear what folks, the experts, are calling for 2025. And I know no one better, no one that collects more complete information than this young man, Lance Lambert, Resi Club founder and good friend of the show. How you doing, Lance?
Doing great. Thank you for having me. Housing. There's always so much going on.
Especially at the end of the year, you start to recognize people who made 2024 calls and now they're making 2025 calls. So I know you've been going out and collecting data. Well, roughly how many people have you collected data from and who are they?
Yeah. So over the weekend, I sent out a story to my Resi Club Pro audience of my forecast roundup of 16 different forecast models.
Wow.
This is my preliminary one. So at the end of the month, I will have my final one. So for example, I just got Redfin's Realtor.com's that they published. I also go out and collect some of these. So First American is submitted to me. I have Windermere, is that how you pronounce it?
Mm-hmm.
I have Hunter Housing Economics research firm that provided theirs. And then I just got Bank of America's updated. So the one that I'll show here is actually a little out of date. But I'm guessing that the average forecast that I round up probably won't change too much. So of the 16 models that I have, and is my screen shared?
I will do that right now.
Okay.
Go for it.
Yeah. Of the 16 that I've rounded up so far and published, my preliminary average is a 3.5 forecast for U.S. home price growth in 2025 calendar year. Last year, my forecast roundup had an average forecast of plus 2.2 for U.S. home prices. As these different indices get finalized for the calendar year 2024, which we're not there yet because they actually lag the market. But my expectation is that the Zillow Home Value Index, Case-Shiller, Freddie Mac House Price Index, and FHFA, most of them are going to kind of come in with +2 to +4. Zillow being a little closer to 2, FHFA being a little closer to 4. So still kind of close to the average 2.2 forecast that we had last year. But this year, the average is actually a little higher, 3.5 for 2025. And before I get into the forecast, it's always important to keep in mind that these are nationally aggregated home prices, right?
For sure.
These indices are a proxy for, single family existing homes, most of them. Zillow is condo too, but they're a proxy and it's a national aggregate. So on any given year, that can vary greatly. During the pandemic housing boom, at one point, Boise, Idaho was up 40% year over year. And some markets, there was no markets really down, but some markets were like plus 12, right? It's still a lot. Like that's a huge year for those markets. And for 2021, the national aggregate was plus 21%, plus 20 for Case-Shiller, which was an all-time record for 1 year. But you can always have a lot of regional variation. And so if you're at a place where you're growing at like 2, 3, kind of keeping up with inflation, you're going to have some markets that are below 0, right?
Sure.
And you're going to have some markets that are over 5. And so for this year, among the largest markets, you had a place like Syracuse that was plus 9.6. That's almost, that's overheating almost, right?
Mm-hmm.
And then you had Punta Gorda, which I've done a story on their unique set of circumstances. They're down 7.3% year over year, and they're down about 12 from peak, and they're passing through some form of a correction, despite the nationally aggregated market being where it is. And so of the forecast, the most bullish, and this is a huge number that they throw out, but the analyst at the American asset management firm Apollo Global Management are forecasting plus 10.8% U.S. home price growth for 2025. For that to happen, you would have markets in some places up 15, 20%. They're pretty much saying that asset prices like stocks, solid wage growth is kind of including private credit is what they think is going to put upward pressure. I don't like to dog anybody's forecast, because I think if you're going to put it out something and kind of stick your neck out there, credit.
I love that about you. You're the housing guy. You're there to report on and share, which I think is awesome. It's guys like me who could come out and say, wow, 10.8%. That's an outlier.
I was going to throw out a but. The but there is that, from the housing market and the data that I analyze, right, this would be a dramatic shift that I just have a hard time seeing how we get there, right?
Yeah, I spent a lot of time, because I'm a follower of yours. I'm a member of your pro version, and the only way I could see getting to 10.8 was a two-step process. One, rates have to fall precipitously, and I'm talking sub 6, probably sub 5.5 for sure. And second, we have to have some kind of first home buyer incentive. We have to incent demand and then keep supply out of the way. I mean, you could theoretically get to, you call it 11%, but it's going to take a couple of outside factors that I don't think anybody else is calling for.
Yeah. Yeah. So with that one, it's a big shift. However you get into that world where that occurs, it's a shift, right?
Correct.
It's not that we go into next year and that's just where we are. Something had to happen.
Exactly. Something had to, yes.
Next up, AEI Housing Center. Ed Pinto, he's a really great housing analyst at the think tank AEI. If you ever get to hear him speak, it's somebody you really want to hear speak, because he has just such knowledge of like the past 40, 50 years for zoning across the country. Really smart guy. Definitely, if you ever see any video that he does, listen to it.
Ed Pinto, wrote him down.
Yes. Huge nerd, though. But he expects 5.5% appreciation for next year. And that's actually what he sees for like multiple years after that, too. He's fairly bullish. Yeah. So I actually considered him the biggest bull that I track. And then AEI came out with this 10.8 and then kind of blew him out of the ball. But I still very much see this as like a bullish forecast.
Yeah.
Because even it is still a shift from the current trajectory.
Okay.
Maybe not as dramatic of a shift as you get with Apollo.
Yeah, I think to get to 5.5, if we just have rates at 6, you could see 5.5. Unlike the other one, which took a couple of things to break. I think just slightly lower rates could bring in a 5.5. I think that's reasonable. Well,
the other thing is I have, I go back and forth. Like Logan Motoshami kind of agrees with you, where 10.8 is an environment where rates came down, right?
Yeah, precipitously.
My view is maybe a bit different how you get to 10.8. It's maybe rates came down, but it's the Fed messes up and there's another inflationary shock that comes immediately, like almost like a 70s. It doesn't have to be a 70s as much appreciation, but there's the initial shock and rates went up a lot, and then the Fed comes down, and then the next shock catches them off guard, right?
It's funny you bring that up, because I've been warning people. It's actually the early 80s. We had the first bump in the late 70s, and the second one came where the Fed thought they licked inflation and they got smacked with that double dip. And it was a nasty recession. 82 was a nasty recession.
Yeah. That's the third shock. Yeah, that one. And that's when really, Volcker really just put his foot down.
It was forced. Forced.
Where they had messed up before. And so Wells Fargo, they're bullish. 4.9% is their forecast for this coming year. And
5 and 26. Woo.
Yeah. So back to back. Bank of America, 4.7, and then they were 0.4 for 26. So they think pop, and then a bit of a pretty big slowdown. I just got back with their mortgage-backed securities team, and they actually have changed this. And it's more like 2 something here and then 3 something in 26.
Oh, so more people are going higher in 26. That's interesting.
So they kind of flipped it. The end point of their new forecast is pretty much the same as
just
one.
How you got there.
And this one was published in June, which is why after I ran this, I was like, you know what, let's reach out to them and just see if anything's changed.
Cool.
Goldman Sachs is 4.4. One thing to keep in mind with Goldman is that the investment bank has 2 different teams that forecast home prices. One of them is their overall U.S. economic team or global economic team, and they're forecasting for a slew of like huge metrics, right? Unemployment, GDP, all of this stuff, right? And so home prices are there. And then they have another team, their housing team, that does a roll-up model, which this is also what John Burns does. This is what Moody's does. They forecast for every metro across the country, and then they roll it up into a national aggregate.
That makes sense.
That's the housing team. The numbers this year, looking forward, are about the same. But if you ever see another number that's kind of a little different, you probably saw the roll-up method. And the roll-up one is when I sometimes publish like a 25, 26, 27, 28, like multiple years out. That's usually that model that I'm pulling from. Capital Economics, they're 4 for 25, 4 for 26. Fannie Mae. Now here's kind of where we start to like slip from what I kind of consider fairly bullish crowd.
Bullish, yeah.
It's maybe even a step up from where we were this year, or kind of really close, but step up. Fannie Mae, and this isn't a bearish forecast at all, but this is kind of more in the, this might be actually what you call the healthy group, right? Okay. Where these are the bulls, and this is kind of like, home price is kind of close to inflation. Right. We're not getting worse for affordability. Their forecast is 3.6 for 25, followed by 1.7 and 26. Housing Wire is 3.5 for 25. I talked to Logan, and Logan's not as high for this. And then Mike Simonson is a little higher. And so they kind of met in the middle is their forecast. Morgan Stanley is 3 for 25. They were the most bearish coming into 2024. They had expected minus 3%. Although I think their team had put in some commentary saying, they might have been a little skeptical of the model, but that's where they were. Now they're plus 3 for 25. Zillow is plus 2.9%. This is, and Zillow does 12 months out, and I think they're about to do November. So this will be updated next week. And so I don't have a full calendar year one for them for 25, but usually if you're forecasting this for this period, the 2 months out is about the same. One thing with Zillow is that Zillow publishes a forecast on their website every month. And that one's 2.8% up. I go in and I get the raw data from their Metro one that rolls up, and it's 2.9. So I like to use that one because it's apples to apples with the Metro analysis map that I make for them every month. Oh,
makes sense.
So you'll always see a little bit of a different Zillow number that I print versus everybody else.
Okay.
CoreLogic is 2.3. They're again another one that does 12 months out. Huge real estate data giant. It was great at Resi Day having their chief data and analytics officer come in, a really smart guy, John Rogers, and talk about home insurance. If you want to see that one, because he kind of really gets into what has actually driven home insurance up, and there's actually a lot of different things to go into it, like 6 different key points. You could Google CoreLogic, John Rogers, Resi Day in YouTube and probably be able to find the video.
Nice.
Zelman and Associates, this is an old forecast from April. I still wanted to include it. I will reach out to them to see if they updated it. But Ivy was plus 2.5 for 25, plus 3.1 for 26. Ivy was on the more bearish end of the group for the second half of 22, kind of coming into 23. She's since kind of pulled back on that, as many of the forecasters have. She says right now weakness is most pronounced in Florida, Tampa area, Sarasota, Naples, Orlando. Areas in Texas, Dallas, Austin, and Dallas are weaker. And then she says the resilience is the Northeast again, which if you read Resi Club and you probably listen on your YouTube channel as well, that's really been our theme for this year in terms of where is the relative weakness and relative resilience. Again, weakness doesn't mean crashing. When you talk about relative weakness, it's to the rest of the country. I think that's a key point as well. And same with resilience. That doesn't necessarily mean those markets are booming. They just might be more resilient than the country as a whole.
Okay.
I think is a great way to describe much of the Midwest, Northeast, and really pockets of California this year as well. National Association of Realtors, they're forecasting 2% for 25, 2.3% for 26. And one thing you'll note with my roundup is that a lot of different places use different indices to forecast for. Zillow does the Zillow Home Value Index. CoreLogic does the CoreLogic Home Value Index. Goldman Sachs always does Case-Shiller. So does Bank of America. National Association of Realtors uses their median home price, which I think is a good level of nuance, because if you don't have them do that, then they could just kind of next year, once the year's over and they're like, well, this is what it was. And they kind of point to whatever indice they want that kind of supports their number, is one reason that I'm having them all provided this year. Mortgage Bankers Association. Now, this is kind of where you start to get into, I wouldn't
Bearish.
describe these as relatively bearish.
Yes,
right?
relatively bearish.
Yeah. Whereas Apollo Group is actually just bullish. And some of those other ones are kind of relatively bullish. This group above, let's say from Fannie Mae through National Association of Realtors, these are kind of like the healthy group, right?
Yeah.
Maybe you can call it boring, right?
Boring.
Mortgage Bankers Association plus 1.5 for 25, 1.5 for 26, 2.2 for 2022. In this type of world, you're going to have some markets that are, fall 10%.
For sure.
Some of the pockets of Southwest, maybe, right? Not in 1 year, right? But over a multiple year period for this level of like very timid growth, something happened, right? Like the early 90s, when you saw that, early 90s, national prices very resilient, right? California and some of these other areas, not so much.
Not so bueno. Not so good. Yep.
Freddie Mac is 0.5% for 2006. Wow.
And if you adjust for inflation, that's a negative number.
Yeah, you're getting down for real. No, that does. You could also argue that maybe this is the group that's healthy, right? Because then you actually start to improve affordability.
Sure, affordability gets better. Yep.
Yeah. Moody's, their model has been relatively more bearish than most of the models that we track for a few years now. And a lot of that comes down to the fact that the Moody's model and Mark Zandi, they just think that housing affordability is such an issue that it's going to be weighing on the market. And
housing affordability is interesting because, a lot of people got this wrong. We got it right here on this channel. Housing affordability impacts transactions long before it impacts price. A lot of people have been pointing out housing affordability and saying housing prices have to crash or fall. No, they don't. We just have to have less transactions. And you can go back and look at the 80s for a perfect example of that.
Yeah. But I think one thing that Mark has done well, if you look at his model, is that it's constantly been more bearish relative to other ones. But the model, when you break it out, is usually more focused on the Southeast, some of the Southwest, Texas, like Austin, theirs has definitely always done a good job picking that up. Yeah. And then some of the Mountain West ones. Now, as the market, the market really stabilized a lot in 23, but we have seen some weakness come into the market in 24, and it has been concentrated to those areas.
Sure.
And then you have Florida, which had the condominium market shock and then the insurance market shock as well. And that has started to give up, especially in the condo market. So it's this, the Mark's model is probably pulling more into the vulnerability from affordability, right? And that's where he has this. But just because the market doesn't necessarily manifest as much of that, doesn't mean that vulnerability from, the overheating that happened during the pandemic has all faded away, right?
Yeah.
And so there could be unique sets of circumstances in some markets that push those markets into corrections that would otherwise not occur in 2018, 2019.
Sure.
Like Punta Gorda that is in correction mode. I don't think Punta Gorda, the circumstances that have kind of like, pushed it over the edge, maybe that hurricane Ian in September 2022. some of the pullback in migration, and then the insurance shocks. I don't think that all three of those things, if those occur in 2018, 2019, I don't think that's enough to push that market over into correction. But the fact that they went up 70% for home prices when the nation went up 40 in a 18-month period during the pandemic housing boom probably created more of the vulnerability.
Oh, for sure.
Other things then. So that's what I'm getting to there. And so Moody's 0.4, that's the only, and then followed by a 0.7% uptick in 26.
A couple of things about your wonderful article here, and I have an unfair advantage, read it before. There's a couple of things that I noted. One is how many people think 26 will be better than 25?
That was interesting. Yeah.
Yeah. It seems to be a pretty consistent trend, at least 80% from memory. We're like, hey, 26 will be better than 25. The other thing that I was left asking myself, and we can take Moody's as an example and Apollo Global Management as the extremes. In my mind, there's an interest rate assumption also behind them. And if I had to guess, Apollo's going to lean lower and Moody's would lean higher. Right. I'm not going to make a call on the number, but I think a lot of things, and it's back to the affordability question and really about transactions, which is the grease, is what will 30-year mortgage rates be? I'm going to guess Apollo thinks lower than Moody's.
I could get you marks real fast because I'm also working on my mortgage rate forecast.
I'm just going to wild ass guess Marks is over 6.8. As you go look it up. I'm just guessing.
So one thing that's interesting about Mark is he's one of the few that he made his mortgage rate call in summer 2022 for like all these years, and then he's never moved it.
Oh, good.
He finally moved. He had it 5.5 ending 25, like since 22. Like that's where he's always thought that once the market made it through this volatility, that's where he believes that long-term mortgage rates
5.5.
Yes. Yeah.
Wow.
Going back to 4. He thinks like he's not like what's the group? What is now? This is no longer his prediction for the end of 25. By the way, that's his view on the long-term.
Like the long-term running average will be okay.
When you take into effect the population of the U.S., productivity, economic growth, long-term. In a normal market, that's kind of where he thinks the mortgage rates line. So kind of out of the ZIRP error of where we were kind of closer to 4. He's now forecasting 6.3% into 20.
Lower than I thought. Okay.
So he came up 0.8. So that was actually.
So I just want to make sure I understood that. So he's having a call for 25 that mortgage rates will be 6. An average will be 6.3, and he thinks. By the end, and he thinks that will lead to a decrease in home prices of negative 0.4. Those two are tied together, right?
Those both are in the same model. Yeah. And I don't believe he has, Mark, I think doesn't have a huge economic or unemployment weakening either. Yeah. It's that just his view and Mark, will say that some of these, the levels of confidence in some of these things, right?
Like I love the fact that Mark doesn't change. I mean, that is something I wish more people did. Hold to your guns and then explain after it comes in. But I got to tell you, 6.3% mortgage rate, which is down about 70 basis points from today, and we have a home price decline of call it 1%. Those do not tie in my head.
Here's how you would have to get there. Let me just throw out a scenario. And I'm not saying now it's a lot to move the national aggregate down to that level.
Correct.
Because going from 3 to 0, which is essentially what this is, but this is pretty much 0. It is still a shift, right? Like how we talked about how AEI Housing Center, like this is a shift, right? Correct. Apollo's a shift too. These ones are not as much of a shift, right? This is kind of as is. What you would have happen is you would probably need this move up that we're seeing in unsold new construction inventory, right? Okay. Which is very concentrated in the southern half of the U.S., right?
Very true. Yep.
Right? You would have to get it to a point where builders get very uneasy. And to move this product, they have to do bigger affordability adjustments, right?
Correct.
Now, you could have you could make the argument that as they do those, and if margins compress too much, they might stop building, right? And then you would say, well, that could reduce future supply. But that's so far out, right?
Yeah. Okay.
Whereas if the builders had to do bigger affordability adjustments, and then that puts the resale side of the market at more of a disadvantage, and then active inventory builds there more.
Sure.
And then you see the number of markets in the US that are down year over year, which is around 15% of the market right now. If that were to get closer to 35% of the market, I think you could kind of almost get the numbers to work.
Yeah.
But I'm like threading the needle with this, right? So I don't think that mortgage rates are everything, right?
No, they're not everything.
A lot of these markets, it's the local fundamentals that are ultimately driving it. Now, definitely mortgage rates have a direct impact on housing demand, right? As they move. But I'm just kind of like, if you asked me like, Lance, get me to minus 0.4 for the US, I think that would be it. The problem now, that would not be the direction that I would come up hypothetically, but I have to work within Moody's framework here, which they think unemployment will be stable. They think that mortgage rates will come down, and they think home prices are pretty much flat. So to get me there, I have to work through that. Now, if you tell me what is the most likely scenario or framework where national home prices fell, and I don't have to use Mark's framework, I would go with the recessionary route, right?
Yep.
Where we have some type of brief, contraction in the economy. And it doesn't necessarily mean that home prices fall 26% peak to trough like they did at GFC, but there could be a scenario because affordability is so strained and what type of shock it is, where I think you could kind of get there.
Yeah.
And now with Apollo, it's very opposite, right? Where it's rates probably came down, the Fed kind of pulled back, and they messed up, right? And that inflationary shock takes off. But otherwise, a lot of these are kind of like status quo. It's just a continuation of where we are, and a little bit here or there kind of moves the market maybe a little bit closer to their forecast. And so of these 16, the average is an increase of 3.5% in 25. I can give you a few more if you want them.
Sure.
Red now 4. They just published theirs, so that's not in my roundup. That came out afterwards. Realtor.com is 3.7. Windermere is 4.9. And I can pull up Hunter Economics if you wanted to.
Yeah. While you do that, folks, don't forget, if you're not getting Resi Club or Resi Club's daily newsletters, at least 5 days a week, you are missing out. Go to ResiClubAnalytics.com. It is how I stay up to date with the housing market.
Okay. So Hunter Housing Economics, which Brad Hunter is really great. If you don't already, I'd recommend following him on LinkedIn, especially if you have any interest in build to rent. That's what he's really great for. He is forecasting 4.1% for 25, 3.7 for 26. And so when you add in those, maybe it gets up to an average of 3.6, 3.7. But my final average will land somewhere between 3.5 and 4 once I've rounded them all up. I think it'll actually be like 3.6, 3.7.
Lance, you're amazing. Housing. Folks, right now, go to ResiClubAnalytics.com, sign up for the free newsletter. And if you are a data geek, you got to get the pro version because you have no idea how much data is behind there. Lance, take care. You're amazing.
Thank you for having me.